Hello and welcome to this latest video update for the Lowland Investment Company. Today I'm joined by co-fund manager Laura Foll. Laura, thank you very much for joining me today. Now there's been a bit of activity in the year to date on the trust portfolio. So what can you tell us about some of the key buys and the key sells?
One of the biggest purchases year to date has been RBS, Royal Bank of Scotland. That's quite an unusual purchase for Lowland because we haven't had any domestic banks since the financial crisis. The reason for purchase is that we think the dividend yield is really quite attractive to shareholders. So they've recently announced a special dividend. We think they can do share buybacks as well, which means that the total return to shareholders we think will be attractive. So that's been a new position. It's quite a large holding. It's over 1% of the portfolio. Other areas that we've been adding to are names like Severn Trent, which is a water utility in the UK, where again we think the dividend yield is really quite attractive and it's trading at a lower valuation than it has done historically. Very broadly, we think the best opportunities in the UK within the FTSE All-Share are in the more domestic companies, so that's where we've tended to be adding to.
Now, given the very uncertain political and economic outlook for the UK, what can you tell us about the positioning of the portfolio? Are you looking for less risky companies, for example?
If we drill down into Lowland in terms of where the sales are of the underlying companies, we would be about 50% exposed to the UK. That would be more than the benchmark, which is the FTSE All-Share. If you drill down into the FTSE All-Share, there would only be about 25% sales exposure to the UK. So we are more tied into the domestic economy. We don't mind that. We think that's where the value is at the moment. If you were screening for value across the UK market, across the FTSE All-Share, you would find that the domestic companies are trading at quite a valuation discount. And therefore, as value investors, that's where we are finding the best opportunities. So we don't mind that we are more exposed to the UK. But that certainly is not in favour at the moment. The UK, on any metrics, if you interviewed fund managers, if you did a global fund manager survey, the UK would be right down the bottom in terms of people wanting to be underweight. So it's not in favour, but that is where we are finding the value.
Now, in terms of company size, how is the portfolio divided between large, medium and small cap companies? And how do you look at the portfolio when thinking about it in this way?
If you went back historically, the portfolio would be split roughly a third smaller companies, a third medium-sized companies and a third large companies. At the moment, we have more like 40% in the FTSE 100, the larger company end. That's not because of any top-down decision that we want to be in the FTSE 100. That is purely a case of where we are finding the value across the market. So, for example, the RBS position that I spoke about, that would be in the FTSE 100. Severn Trent, the water utility, is also in the FTSE 100. But that isn't why we're adding to the holdings. We've just found that the value is there. So at the moment we have 40% in the FTSE, but that's not a particularly negative reflection in any way on the FTSE 250 or FTSE small cap. And actually, if you go over the long term, we think the best value opportunities, I'm talking 10 years plus now, will be in those smaller and medium-sized companies because that is where the best sales and earnings growth will come from, purely because of the fact that those companies are smaller and therefore at an earlier stage in their life cycle and they have more scope to grow. So over the long term, if you looked at where the performance had come from over the last 10 years or so, it would be the smaller and medium-sized company end driving that performance, and we would expect that to continue.